For weeks, the whole question of a December interest rate cut, well, it seemed pretty much settled. But as we all know, in the world of finance, a week can feel like a lifetime, and this entire conversation just got completely flipped on its head. So what on earth just changed? Well, the jolt came from Wall Street's biggest and arguably most influential bank. They just did a complete 180 on their forecast. And a single move like that, well, it sends massive ripples through the market, changing pretty much everyone's expectations almost overnight. We are, of course, talking about JPMorgan. For weeks, their top economists were adamant, arguing that the Fed was going to hold off on any rate cuts until January at the earliest. But then, bam, in a sudden reversal, they've completely changed their tune. And you can just see the shift right here. They've gone from wait until January, a real wait-and-see approach, to forecasting a quarter-point cut on December 10th. I mean, that is a huge change in outlook from one of the most watched banks on the entire planet. And listen, it's not just JP Morgan. Suddenly, it feels like a chorus is forming. Now Goldman Sachs is telling its clients to expect the same thing. You're even hearing hints from inside the Fed itself, with New York Fed President John Williams backing a sooner rather than later kind of move. And the big reason everyone's pointing to, signs that the job market is finally starting to cool off. This whole pivot from Wall Street is just adding fuel to what's already been an absolute roller coaster for market expectations. Seriously, over the past month, the odds of a rate cut had been swinging wildly, and it just goes to show how uncertain the whole economic picture has been. And what's really fascinating is just how dramatic these swings have been. Back in late October, a December cut was seen as a near certainty, almost a done deal. Then, after a government shutdown delayed key jobs data, those odds just plummeted down to 30%. And now, the pendulum has swung all the way back, with traders pricing in something like an 85% chance of a cut. What a ride. So, why all the back and forth? Why is everyone so uncertain? Well, it all comes down to the U.S. labor market, which, to put it mildly, is sending completely mixed signals right now. It is a genuine puzzle for policymakers. So on one side of the scale, you've got these clear signs of cooling, right? The unemployment rate is at a 4-year high, and job openings have dropped. But on the other side, companies are still hiring. They added another 119,000 jobs last month. Employers just haven't slammed on the brakes. So if you're the Fed, what do you do with that? It's an incredibly tough spot to be in. Yeah, and this quote really just nails it, doesn't it? The recent government shutdown meant that crucial economic reports got delayed, basically forcing the Fed to try and navigate this super confusing landscape with incomplete data. Okay, so let's translate all this economic puzzle stuff to the stock market. Why does this all matter so much to investors? Well, because when the Fed acts, the market listens very, very closely. Well, the thinking here is actually pretty simple. When the Fed cuts interest rates, it gets cheaper for companies and for you and me to borrow money, which can help get the economy moving. But, and this is the big one for investors, it also makes boring old government bonds less attractive, which can make stocks, with their higher potential for returns, look a whole lot better by comparison. But wait, there's more. It's not just about the rate cut itself. If the Fed does decide to pull the trigger, they'll be doing it in a month that already has this incredibly powerful seasonal wind at its back. And when you look at the history, it's pretty wild. Going all the way back to 1930, the S&P 500 has finished the month of December in positive territory nearly 3/4 of the time. That is not a coin flip, folks. And we're not talking about tiny little gains either. The average return for the S&P 500 during December has been a very, very healthy 1.4%. And if we zoom in even closer on the calendar, there's this powerful little micro trend that a lot of traders know as the Santa Claus rally. This is all about the last few trading days of the year and the first 2 of the new one. And during that specific window, the market has finished positive an incredible 79% of the time since 1950. Think about that. That's just a remarkably consistent and powerful trend. And look, this isn't just theory. We have seen this exact combo. Easier Fed policy and that December strength play out before. In 1998, 2008, and 2019, rate cuts were followed by really strong December gains for the stock market. So there's a real precedent here. So that's the setup. All of this brings us right back to the Fed's huge upcoming meeting. They've got to weigh every single one of these conflicting factors and make a call that's going to have major consequences for the entire economy.
So here's the dilemma in a nutshell. They're looking at a jobs market that's slowing down, but it's not falling off a cliff. They're feeling the heat from Wall Street's sudden change of heart. They know the history, they know the trends, and they have to make this call while, flying with one eye partly closed.
So with the holidays right around the corner and the market just hoping for that year-end rally, the big question is the Fed going to play Santa Claus and deliver a welcome gift, or are we all getting a lump of coal? We are all going to find out on December 10th.